Vantage Point with True North Wealth Partners is for our clients and those wanting to learn more about what's really going on within the markets and economy, as well as overall financial planning topics.
Hi, everybody. Welcome to another episode, number 42 with Vantage Point with True North Wealth Partners. It's Eric Susi. Today is Tuesday, January 23rd. So already the holidays have come and gone. Hopefully you all had a blessed holidays, Christmas, Hanukkah, New Year's, and already off to 2024. So the year has flown by thus far. Winter has finally arrived here in Ohio. So we've had about a week and a half of cold weather. So yes, we've had a little snow and it's all good. So with that said, going to dive right into it. A little bit of a recap for 2023, how it was an interesting year. And just to put a little bow tie on it so people understand, what happened and why per se. So basically, and this is just a chart here from Hedgeye. Again, one of the research partners that we do use, okay? So Hedgeye, risk management. So it's the big G. So big G of the government spending. So government spending, as you'll see, $2 trillion in total. That's comprised of the bipartisan infrastructure bill. Okay, it's about $1.2 trillion. The CHIPS and Science Act, you can see that amount. The Inflation Reduction Act as well, $280 billion. So all that combined is roughly $2 trillion. So that's great. Again, government jobs. That's most of the jobs have been government jobs for 2023, as long as government spending. So that helped keep the party going a little bit longer. In addition to that is the ERC. I know you've heard me talk about the ERC, the Employer Retention Credit. That's money, free money given to the employers on behalf of employees. Again, $26,000 per person. So that got a little carried away. The government figured out it was being compromised. And so therefore, they stopped that in the fall of last year. But a lot of, billions of dollars went out the door anyways. So with that said, they're thinking about the administration's trying to possibly turn this ERC money back on in January. Has not happened yet. So remember I said I'm going to be monitoring that. So it hasn't happened yet. They're doing other things, free student loans, even though they went against the Supreme Court decision, unconstitutional. So they're trying to go around that last week. They're trying to, do administrative order there again. So it is what it is. But those are the three government plus the ERC money, the four things there that kept things going. So that sums up where all the spending and where the money came from. The narrowest leadership. So this, just briefly, just a quick show. So this is the narrowest leadership there. So one of our other firms I listen in on, sources come from LPL, but Bloomberg as well. So with that said, narrowest leadership in 40 years. I'm just going to read briefly here. So basically on this bar chart going back to 1983, for 2023, only 26% of the S&P 500 stocks beat the index last year. So only 26% of the S&P 500 stocks beat it. So that's the lowest since 1998, okay? So I thought that was interesting. I just wanted to point that out. And the average is closer to about 40, almost 49% is the average. Going back from 1983 through 2003, the average is almost 49%. S&P stocks beat the index. Last year was the lowest since 1998, came in at only 26%. Again, the narrow leadership we've talked about all year long was the Magnificent Seven, did branch out to about 10 companies, et cetera. So this year, interesting, I would start out, it's really momentum. Okay, so momentum is taking the leadership. So not necessarily quality or value, it's momentum. Whereas last year it was not momentum. So I think it's interesting how things and money flow has changed a lot over the past 3 weeks here. This is another summary going back to First Trust, one of our partners. Just hold it up briefly so you can see where I'm getting it from. So again, First Trust is one of our partners, and this is pretty cool. So there's really over 200 economists worldwide, and the First Trust put together basically like top 20 or the 20 largest type of economist researches. This is S&P 500 Index strategist projections for the year end of 2024. So how will the S&P end in 2024? As you all know, everybody here at True North Wealth Partners knows, nobody knows. It's a crapshoot. It's roll the dice. That's what the stock market is. I'll say it kindly. It's legalized gambling in a fun way. So projected percent change of the S&P 500 Index. The highest, Fundstrat and Oppenheimer come in at 9%. So they project the S&P 500 will end the year at 9%. The lowest is Cantor Fitzgerald at minus 7.8. And JP Morgan Chase comes in at 11.9 negative. So again, Cantor Fitzgerald's minus 7.8, JP Morgan minus 11.9. So with that said, again, with all the other 20 in between, so some are high, some are low, with the average of all 20 are coming in at 1%. So 1% is the expected return for the S&P for 2020. So there you go, folks. You've heard it. It's going to be a crazy year. You thought 2023 was something? Strap in. 2024 will be even crazier. So I just thought that was really enlightening. So that's, hey, Eric, what are you all thinking about this year? It's just going to be volatile. This one, Hedgeye, again, one of the main research partners that we use. Ian and Nathan can blow up on this one. This is cool. This talks about the projections on the monthly quads. So you all hear me talk about the quads for the month. Quads 1, 2, 3, 4. 1 and 2 are good. 3, things are slowing down. 4, it's not good. Everyone's losing. And you want to just preserve as best you can. So what's interesting, and while he's holding that up there, again, August to September and October, check that out. So August was a quad 3 month, okay, September a quad 2 month, and October of 2023 was a quad 4 month. So I circle that. If you recall, during that time period, that 3-month time period, the S&P was down over around 10%, okay? So keep that in mind. 3 months of a 3, 2, 4, and then down 10%. November, okay, that was a quad 1 month. And then December came in at quad 3. And then you can see projections. So the blue box moving out to the right, this is just a forecast. This gets updated daily from Hedgeye, okay? So it has multiple factors that feed into this. But my point is this is a roadmap of what to expect month by month. So we're in the thick of things now in January. So it should turn out to be a quad 4. February, it's the highest probability there. You can see the probability for February, again, at quad 4. And then March and April, quads 3, quad 3. So these next 4 months are going to be challenging. And then that's why we're saying the front end will be more challenging probably than the back end based on this information here. So a lot to absorb right there, but sort of a roadmap. And then if you look out, if you say, hey, Eric, okay, why is August a quad 1 month? Okay, so that's that little spike again. It's because the Fed will have already begun cutting rates, and the markets are going to love cutting rates. So a little interesting factoid there as far as what to project. And again, this changes daily with inputs that come in from Hedgeye. So at least want to provide that with you, to you. So how we build models and still have a defensive tilt to things of that nature. So with that said, let's sort of get into, I guess, a couple things. Davos. So Davos last week, they had their meeting, okay? So, I'm not, Nathan will hold that up. It's great. So cartoons from Hedgeye and Bill Rich does a great job. Those guys in Davos have their heads in the clouds, more like up there, you know what. So it's Davos basically just the globalist elitist, okay? So just to educate you on what this is all about. So Davos is held yearly. It's in Switzerland. Okay, it's a big ski resort, upscale ski resort. They fly in via planes and then take planes via helicopters in. It's a World Economic Forum. It's held there. It's founded by Klaus Schwab. He started it and has been the head of it since 1971. Okay, so they call it as stakeholders and capitalism. Basically, there's about 1,000 members, and you have to pay. It's roughly $52,000 per year, per membership or what have you. Invitation only, okay? So there are not quite, I think it was just shy of 900 folks were able to attend this one. I believe I heard that correctly. So just a little bit of background on that. Just basically, they're globalists, they're elitists. They come together. Some of their slogans: "You'll own nothing and you'll be happy." Okay, think about that. You'll own nothing and you'll be happy. Also, they're going to use COVID. They came out when COVID hit. They're going to use that as the Great Reset by 2030. So 2030, they want to get. Is their goal is to get everything all resetted down by 2030. So you have to understand what's really going on and behind the scenes, and why Europe was exposed to this for years, and all the Green New Deal, and just to understand what has gone on. So why are all these folks now turning? So, and by the way, before I forget, those charts I just rattled off earlier, the information, I have to read this as a disclaimer here. So just for compliance, those charts earlier were information has been obtained from third-party sources which are believed to be accurate, but we cannot guarantee its accuracy or completeness. So it's a little late on that, but I wanted you to at least hear that. So occasionally I may have to just read that for compliance. So moving back on to Davos. So really what's been going on is I'm going to talk briefly about nuclear, okay? So the IAEA, okay, I'm subscribed to them. So the IAEA is called the International Atomic Energy Agency, okay, IAEA. So they've been around for a long time. But sources, just a little history and more factoids here for you. The first city that have nuclear reactors, Arco, Idaho, okay? Arco, Idaho, first city. And Lehigh, Utah is the Idaho's national laboratory. They're starting to build, it's called the SMRs. SMRs are the small modular reactors, okay? Small modular reactors. You're going to hear a lot about that. So with this, Nathan will punch into this. This comes from the IAEA again. So this is a nice little chart, and then walks you through. Remember back to 7 Miles Island, the nuclear reactors and all that. That's the large conventional reactors. They produce over 700 plus megawatts, okay, for big cities, et cetera. These small modular reactors are up to 300 megawatts, okay? And then you have these micro reactors up to 10 megawatts. So you can see the small ones are less than the size of a truck. Small modular reactors are a little bit bigger, obviously, than you got your big ones. So the way forward to all the cleanness is using nuclear. It's the cleanest, and these small modular reactors can all be pre-built, prefabbed, and then just delivered on site throughout cities, rural areas, et cetera. So it helps back up all the components for the wind, solar. It's more reliable, it's steady, backs them all up. Solar, wind, hydro, et cetera, even gas and coal too. So you have to have it all is what I'm trying to say. So you're going to hear more and more about nuclear, and hence there's a fund that we're looking at as well. We'll probably get into moving forward in regards to that, to capture that space. So again, I got together with a buddy of mine. He's a PhD, a doctorate in nuclear science, smart dude. This is all he's done all these years. And he and I have spoken about all this over the years, but I saw him recently here in December, and he reminded me of all that. So that's why I wanted to at least bring this to the forefront of what's going on. In addition to that, like I mentioned, Idaho and Lehigh, Utah, they're building an SMR there. So they're starting to build one, the first one in the United States, small modular reactors. Quick little factoid. China has 9 nuclear reactors under construction. China, okay. They have 49 coal factories that they've been uncovering and building over the past few years, 49. But at least they are looking into under construction for nuclear. Russia already has an SMRU occurring today, so they have one out there. India is also building one as well. So most of the climate destruction comes from China and India, okay? So just to keep that factoid out there in everyone's fresh minds. So I just want to educate everyone on what's going on there. And also, there's 450 operate worldwide nuclear reactors, and there's 24 countries that are looking at nuclear. So in addition to 450 that are operating, there's 24 countries that are also looking at it. Again, this all comes from the IAEA. And lastly, 10% of the world electricity is nuclear power today. So again, 10% of the world's electricity is currently from nuclear. So again, just want to educate you a little bit there. Again, all the information has been obtained from third-party source and we believe to be accurate and cannot guarantee its accuracy or completeness. Just want to reference that. So that's Davos, nuclear, where we're going, what the markets have been doing, etc. The next big thing that occurred this month is Bitcoin. Woohoo! So Bitcoin basically came out. Remember, we said we're not really going to touch it until it gets, SEC approves it, quote unquote, approve it. So basically, Bitcoin came out. There's ETFs. There's 11 of them that came on January the 11th. Been on like 3 or 4 calls. I did narrow it down to which one I will be using. If or when I do want to use it. Right now, I still don't, but at least I narrowed it down of the 11 or so, the one I will be using. So with that said, so we checked that box. But interesting how Bitcoin is down over 20% since January 11th. Okay, so Bitcoin's down 20%. Market technician and historian Larry Williams, who also brought this up, I follow him. He's been doing it for 60 plus years. Says we're nowhere near a bottom. That's come from Larry Williams. This is coming from CNBC, dated here on January 23rd from CNBC's newsletter there. So I just wanted to point that out on Bitcoin, and I find it very interesting how it was a big thing, and like I said, it's been 12 plus days and down 20%. Intraday, Bitcoin hit 49,000 intraday on January 11th. Big spike up, big movement that day. The debut of those 11 new spot ETFs came out, hit 49,000 intraday, and Bitcoin's now trading at below 39,600. So I just find that really interesting. Also, just talking about the markets in general, China coming off. China's mulling around whether or not to prop up the struggling domestic stock market with a $278 billion rescue package, according to Bloomberg. So it's just basically, they're just trying to, it's been 3 years, China declined. We have not owned China. I haven't owned China in 3+ years, which is a great call. So it saved you from all that. Also, China announced that you cannot short the stock markets. Long means call up, short means, going short the market. So they're removing any short. You can't short stocks. So they're artificially manipulating the markets, like what's been going on here in the United States in the stock markets of late. So a lot of market manipulation going on. Again, that source all coming from CNBC, dated January 23rd. So just want to throw those informational factoids that are out there. Let's see. Again, information obtained from a third party, which is believed to be accurate, cannot guarantee its accuracy or completeness. Okie dokie. So with that said, another historical thing that has occurred this year. So in addition to the Bitcoin is the Dow. So the Dow closed over 38,000 on the Dow, first time on Monday. So that was yesterday. Great. All-time high also for the S&P. So those are all-time high. For the Dow and the S&P. And the S&P, that's the highest since January of 2022, so 2 years. So the S&P's gone nowhere pretty much in 2 years. But the point is, they're at all-time highs for the S&P as well. NASDAQ is about 4.5% away from its November 2021 all-time highs. So NASDAQ is still not there, still lagging by 4.5% away from the November 21st, again, record high close. So I just wanted to mention that there's a lot has happened thus far into this year. So with that, let's sort of move on to earnings, the S&P. Talk about the economy. This is all from another little clip it there, Bill Rich. I love it. So sure, you can look under the hood, but it isn't pretty. So that's the economy. So I always like to make reference to that. So why do I say that? Because again, rolling recessions parts are still underwater, parts are doing good. So you have just a rolling parts of the economy are good, other parts are not. We believe things are going to come to a head here the first half of this year. So nothing major, normal pullbacks, 8, 10, 12%. That's common. So we do anticipate that in the S&P 500. Again, that's our belief, what I'm thinking, et cetera. So I just want to point that out. and based on information from Hedgeye and all the other people we follow. So margins basically, it's the lowest net profit margins in 3 years and more than 3 years for the fourth quarter. So this is coming from FactSet. So FactSet, a great resource we lean on, dated January 22nd. So margins again are coming in at the narrowest since 3 years. So just wanted to make reference to that. And then things are going to get tighter and harder as we get into 2024. This is all Q4 2023, and it's the narrowest in 3 years. So things are setting up for it to come to fruition here. S&P earnings. So S&P earnings, basically with earnings report from Hedgeye as well as FactSet. So the earnings are off to a little bit of a rocky start here, a little bit slower. But the S&P 500 is coming from Hedgeye's call. Actually, it was today, this morning. Roughly 10% of the S&P companies have reported, which is about 55 companies or so, have reported with earnings of a negative minus 3.2%, minus 3.2. Okay, the street, the markets are anticipating a positive 10 to 12% earnings growth for Q4 2023. And so far, it's early on in the earnings, but right now they're negative minus 3.2. Okay, with roughly over 10% have reported. So again, just giving you things that are still out there in corporate debt as well. This is corporate debt defaults, 80%, soared 80% in 2023, and it could be high again this year, S&P says. This is from Jeff Cox at CNBC.com, dated January 16th. So the number of companies that failed to make required payments on their debt totaled 153 companies for 2023. That's up 85 from the year before. It's an increase of 80%. It's the highest default rate outside of the COVID-related spike in 2020 in 7 years. So again, just things are coming to a halt. The comps, the rate of change, year-over-year comparisons, first quarter, second quarter of last year are higher than this. It's going to be harder to comp against a higher, better comps from the Q1, Q2 of 2023. So multiple headwinds are there, rolling recession. Again, all this information I just sourced obtained from a third party, which I believe to be accurate, but cannot guarantee accuracy or completeness. So I just wanted to read all that. So a lot I threw at you there, but at least I wanted to make you aware of what's going on. So, okay, what's going to help the markets? It's Batman. It's the Fed. Okay, so another little cartoon. So relax, Batman. We're signaling the Fed. So that's the stock market signaling the Fed. So that's why you had a November, December rally. The Fed got out there, pal, speaking, we're going to cut rates. He thinks 3 times. The Fed took that as a 5-6 time rate cuts. Not going to happen. Not that many times. If it's that many times, that means we're in a deep, deep recession, et cetera. So the Fed, this is from our website, actually, sourced from the Federal Reserve, a piece that came out on our site. But this is pretty neat. Hold this up. So in case of, you can see this here, there's going to be 8 meetings for this year, January 30th, 31st. So in January, the March 19th, 20th, April 30th and the 1st of May, June, July, September, November, December. So we have been talking about most likely the Fed won't be cutting rates. If they do, it will be at the earliest, it'll be the May 1st meeting. So the May 1st will be the earliest is what we believe. It could even be pushed back to the June meeting. So front half will be choppy, back half, once they do start cutting rates, then there'll be a little bit of a relief rally, et cetera. So with that, just want to share with you that aspect too. Moving on to, I guess, tips of the month. If you don't mind, there's a couple of good tips of the month. Just as a reminder, so for, we're heading into tax season there. So folks, I know a lot of you use our internal, they house here within our office, Robin and Ken. So please reach out to them to get on their calendar. They'll take care of your taxes for you as well. So with that said, they did raise the exclusion for the inheritance up to $18,000 per person for 2024. So if a husband and wife, it's $18,000 from the husband, $18,000 from the wife, can be gifting to a child each. So just make reference to that. The Ohio 529, we spoke in the past too, the Roth IRA rollover. So again, you have to have the account for at least 15 years. You have to have the account at least 5 years for the money to be in there. The aggregate, the most you can roll over, if any unused Ohio 529 program amounts, is $35,000. So that's the most. If there's $35,000 left in a 529 account, you can roll out over $35,000. But again, based on the annual income for the IRA, if it's $7,000, then you can do $7,000 for that year, and then the next year do another $7,000, et cetera. So whatever the IRA contribution limits are, is the amount you can roll over. It has to be a direct trustee to trustee rollover, and there's no income limitations; are all waived. So that's a great little advantage there. Take advantage of that. I talked about the gift tax too. So cool. And again, information has been obtained from a third source party, believed to be accurate. We can't guarantee its accuracy or completeness. That all came from the Advantage Ohio 529 informational sheets. So I always like to source it, gift it, all that good stuff. Next, on the tips of the month, this is pretty cool. So this is why we have a little bit of defense built into a sector, international defense spending fund, et cetera. So we are taking advantage of that. So this is from Hedgeye. Again, Nathan can chime in on that one there. This is pretty cool. But with that said, the fleet is growing plus replacement demand. So old fleet, this is the Navy fleet. So you can see back in 1970, it was just shy of 800 ships. Then you can see in the low, around 300-ish for decades there. But what's really going to take off is the unmanned ships. So I've seen some of this. It's pretty cool. So they're going to have these, unmanned ships. I'm going to read briefly here. So defense spending is anticipated to increase, driven by the need to modernize the Navy's aging fleet and introduce a new technology advanced fleet, including ghost fleets or drones. So that's the unmanned ghost fleets. The situation creates a dual demand, replacing older ships and expanding the fleet with new capabilities. We are in that space, defense, with the government's putting a lot of money into all that. So that's why we're still there. I thought that was an interesting little tip of the month, seeing it graphically wise. I haven't seen that before. I always wondered about, the Navy, and there you go. So the ship count, they're going to increase a few of the ships, but really it's all the unmanned. The next tip of the month, this is really cool. Data centers. Okay. So this is really neat. Data centers. This comes from, source is Cushman and Wakefield. So they're a commercial real estate, but it's also from visualize.com that I get these charts from too. So that's being sourced. So with that said, this data is from 2023, and there's actually about 63 surveyed, data centers surveyed, and they just put together the top 50 biggest data center markets by electricity consumption and megawatts. So there's 63 out there, top 50 that are showing. The reason why I'm showing this is because Columbus is on the radar. So we're at, of all these 50 that are being shown, there's a pink data center megawatt storage. We are the lowest. So look at the Columbus, we're at 41 megawatts, and 1 megawatt is 1 million watts. So 41, so once that's 41 million megawatts is how you interpret that. So we are the smallest, using the least amount of megawatts, but this is through 2023, and around Columbus and Greater Columbus, New Albany, et cetera, they're popping up everywhere. So I show this just to share with you as this changes over the years. I'm curious to see how we really grow. So this is, the gig economy, the Big Brother, AI, all that stuff. It's all being housed in these data centers, government, it's all there. So again, all those information has been obtained from a third-party source, which we believe to be accurate, but we cannot guarantee or accuracy or completeness. That's all from that. All been sourced. There you go. So we covered all that. So I think we're ready to slide into third base, heading from home. Let's end on the charts. Here we go, folks. So some good old charts, Bitcoin and stock market. So I wanted to lead off with the Bitcoin just to visually walk you through it. So remember, Bitcoin hit well over, close to like 69,000, and then it crashed. Back in 21, 22, went high, then it crashed down around 18,000, and then it's hung around there for a while. Then it took off towards the end of last year, hit 49,000 intraday on January 11th of 2024, hit 49,000, then come back down. And then as of yesterday's closing price, 39,815. And then you can see that compared to the S&P, 4850. So an interesting little spot about the good old Bitcoin and the S&P. The PE ratio for the markets, okay, the average PE ratio for the S&P dating back a while is 15.6. And tech bubble, you can see, is 24.5. Currently, we're at 19.7 is where we're at, again, 19.7. Valuations. So valuations, you can see the price to earnings, price to book, price to sales, price to cash flow, and dividend yield. So the X is 1 year ago, and today is the little diamond-shaped little thing. So we're elevated much higher than a year ago. So all the diamonds are north of that, 1 or 2 standard deviations higher. The only good thing is the far right dividend yield. We're making more yield on our income because rates have been higher. So that's the only positive out of that. Yield curve steepness. Again, the 210s of recessions are shaded, as you can see. So it's been inverted, as you can see the far right. It was well over a minus 1% inversion, the 210 spread. Now it's gotten narrowing. It almost was flat about a month and a half ago, back to break even. Now we're only minus 0.26. The common theme, if you can drill into this, is once it gets uninverted, that means Fed starts cutting rates on the short end, okay? So rates on the short end go lower, rates on the higher end stay high or go higher. So that's how you uninvert. And once you uninvert, look back to the back. Once you uninvert, then it goes from being below zero. The blue line goes higher, and then recession, 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 recession. So this is interesting as well. It's been accurate as far as calling recessions too, and just pullbacks, what have you. So again, we're not out of the woods by any means. Mortgage rates, mortgage rates is spiked. It hit over 8%. The average since 1990 has been 6%. Currently 6.6, and roughly over. Around 70% of folks out there who do have mortgages are at 4% or below. So, until rates get around, well south of 5, but in that 4 to 5% range, it won't be a lot of refis. It will help with just a new time in purchasing for new homes, things of that nature. Leading economic indicators, LEI. So this is comprised of the S&P. There's over a dozen indicators that comprise the LEI, leading economic indicators. Again, still negative. 21 months consecutive. So this is incredible. Minus 7.6. This is 21 months in a row. It's been negative. So almost 2 years. And you can see when it's negative, what happens? A recession. So there you go. PCE, I just showed this one. This is the preferred measure that the Federal Reserve, their target is 2% for the PCE on the core PCE, which excludes food and energy. Go figure, go ask why, I don't know. Anyways, so the core PCE currently is at 3.2. Again, their goal is to get it down to 2%. So this will continue to go down, just like inflation, CPI, Consumer Price Index will continue to go down, but again, still far away from their mandate. And this last one here, asset class performers. This is just interesting. I wanted to share this with you. S&P last year in 2023, you can see up 26.3. Again, vast majority is derived of the 10 large companies there. So that's in red. But look at the dark blue balanced portfolio. So using alternatives, balanced bonds, things of that nature, always in that middle range there. So obviously that's what everyone here builds out their models using the allocation theory there. So with that said, you can see what takes turn at the top and bottom, et cetera. So starting out the year, again, momentum has really taken off. Balanced portfolios, fixed income, commodities, EFA, small caps down, emerging markets down minus 5.8 year to date so far. So again, very narrow leadership. Again, it started. Things are still underwater, even though they're hitting all-time highs. So a lot of cross currents. All right, folks. Well, thank you. We appreciate you tuning in for this episode. Hopefully you enjoyed it. We covered a lot of last year's recap, the setup, what happened in January thus far. And oh, by the way, it's an election year. I forgot to mention that. So a lot of action will be occurring. And again, hit that red subscribe button too. Appreciate you following us, and we'll see you next time. Please reach out to us as we're here for you. Take care.
You can reach this episode on our website at mytruenorthwp.com by other podcast venue sites, or by calling us at 614-929-2715. Also, feel free to share this episode with friends and family and sign up for our weekly email market updates via our website. Investment advice offered through Stratus Wealth Advisors, LLC, a registered investment advisor. Stratus Wealth Advisors, LLC, and True North Wealth Partners are separate entities. Opinions expressed in this podcast are for general information only and are not intended to be specific investment advice. It is important to consult a financial advisor who understands your individual financial situation prior to making any investment decisions. Some of the information contained herein has been obtained from third-party sources which are believed to be accurate, but we cannot guarantee its accuracy or completeness. The information should not be regarded as a complete analysis of the subjects discussed.